If there's one thing that the markets are concerned about right now, it was revealed today: the Federal Reserve and when the central bank may begin pulling back on its massive stimulus program. Stocks made a U-turn mid-session today after minutes from the Fed's latest policy meeting were released, showing that policymakers could be closer to deciding on when to start scaling back on its bond buying program. Now, concerned that the Fed's easy money party could soon be ending, that sent the Dow on a 100-point swing to the downside. But the sell-off did cool in the final hour, and at the end of the day, the Dow was down 66 points, the Nasdaq off by 10, and the S&P lower by 6. And hints about tapering sent the yield on the benchmark 10-year Treasury note spiking to as high as 2.8% today. That's the highest level we've seen in a month.
So what exactly was in those minutes of the Fed's October meeting? And why are policymakers so divided on when to reduce its stimulus program? Steve Leisman explains.
Minutes of the Fed's October meeting showing that committee members generally believe the economy will improve enough in coming months to warrant a reduction in stimulus to the economy. Specifically, they could reduce the amount of assets they purchase in the program known as quantitative easing in the next few meetings if the Fed's forecast for a gradually improving economy comes true. But the Fed is also deeply divided over its communication strategy, as it fears that stocks and bonds could sell off sharply when it reduces QE, and it's trying to convince markets that if it does taper, that does not mean the central bank will raise interest rates any time sooner. Fed Chairman Ben Bernanke has struggled with the problem for months, and there doesn't seem to be any easy answers right now. We also learned the Fed held a special emergency October 16th meeting the day before the government was supposed to default to discuss what to do if that default happened. It suggested it could take actions to smooth market disruptions in the event of a default. They generally saw the economy or the economic effects of the government shutdown as temporary and limited. For Nightly Business Report, I'm Steve Leisman.
Well, joining us now to talk more about the Fed and the economy, Bruce Kasman joins us tonight. He's chief economist at J.P. Morgan Chase. Bruce, always good to see you.
Good to be here.
Based on what you know about the economy and the data you see, I mean, the Fed seems really divided about when to start the tapering. When do you think it would be appropriate?
Well, I would say conditional on the economic news continuing to play out in a solid fashion. We think the Fed will be tapering in the first quarter. We think the most likely outcome would be a January move.
You know, Bruce, they have said in the past, the Fed officials, that they were going to have it dependent on when they were going to taper on the unemployment rate, where it was going to be standing, 6.5% and other numbers. Now it sounds like they might be talking about a calendar date. Does it matter to you, and how would this play out with the markets and investors?
I don't think it's a calendar date. I think what the Fed has been telling us is that they want to taper. They don't want to continue to expand the balance sheet in an unlimited fashion. And they want to do it based on their assessment that there's solid growth momentum and substantial improvement in the labor market. There were some fears about that, both with the data and also with the concerns about Washington. And also something we've seen is a Fed concern that the market was linking tapering to rate guidance. What we've had in the last number of weeks is better economic news, a strong payroll report, the fears around Washington fading, and the markets reprice Fed rate expectations, all of which puts them back on track for tapering if we get good numbers in terms of the labor market at the next one or two reports.
But Ben Bernanke is constantly having to defend the Fed for sending what are perceived to be mixed signals. In the spring, they seem to be setting a timetable. Then they go back to the data-dependent argument. Now they're talking perhaps about changing the benchmarks that they will use to determine when. Is this a Fed that's really just trying to deal with changing market conditions, or is it a Fed that's losing credibility? What do you think?
I think it's a Fed that's struggling to hit the right notes on a communication strategy, which has had two different pieces to it. One has been about the quantitative easing, and that's been about momentum in the economy. The other has been about rate guidance, which has been about inflation. It's been about getting the unemployment rate down. It's about healing the economy more broadly. They hold some responsibility for having tied the two more closely together. And now I think the delinking they're trying to do is being complicated, and they're struggling a little bit. But I actually think they've gotten some traction in the last month or two. They've been helped also by the fact that Janet Yellen, someone who's inside the committee, is going to be the new chair. I think they're likely to be successful here, although the difficulty of separating as we move towards tapering is clearly going to continue to be an issue.
You know, earlier this week, Fed Vice Chairman Bill Dudley said that he's more hopeful that the U.S. economy is recovering. What do you think? What is your forecast when it comes to economic growth, when it comes to the unemployment rate? What do you see in the economy?
Well, we're encouraged by the fact that a momentum slip that looked like it was taking place in the summer has apparently been reversed, and we don't feel like we're having a big negative hit from the shutdown. So we're encouraged that the economy's holding in okay here. We do think it's going to be a grind here. The economy feels to us an underlying pace still running 2%. We're absorbing higher interest rates. We think growth is going to pick up, but it's going to take a while here before we get really good growth. We think 3% growth will come, but probably sometime spring, summer 2014. Unemployment rate by the end of next year will be down to about 6.5% if our forecasts are right.
And one metric we haven't talked about is inflation, which they are also wanting to raise before they start thinking about tapering. Now, lately, the inflation data have been very tame. Gold prices are coming down. Oil's hitting multi-month lows. Where do you see inflation right now?
I think we've got inflation globally and in the U.S. at close to record lows. I think it's very important to highlight that because low inflation is one thing that helps the Fed separate tapering from rate guidance. Low inflation is a key issue for when to raise rates. It's not the key issue about when to begin the tapering. So low inflation is going to be very helpful for the Fed here, and we expect it to stay in the low ones here for the next number of months.
Bruce Kasman, Chief Economist at J.P. Morgan Chase. Thanks for joining us tonight.
Thank you.
Well, Bruce was just talking about Janet Yellen, and we have an update on Janet Yellen's nomination to be the next chair of the Federal Reserve. Republican Senator Bob Corker of Tennessee, one of Yellen's biggest critics in the Senate, says he believes she will bring more transparency to the Fed and work to reduce its bond buying plans. As a member of the Senate Banking Committee, Corker says he will vote to support her nomination tomorrow, sending her bid to the full Senate.